Who controls Bitcoin? According to Bitcoin.org, the answer is, quote, all Bitcoin users around the world, including Bitcoin miners, developers, and holders. So, in theory, nobody controls Bitcoin.
Nobody?
Nobody.
In practice, however, powerful entities, including asset managers like BlackRock, are trying to control Bitcoin by investing in miners, funding developers, and accumulating billions of dollars worth of BTC. And that's why today we're going to take a look at who is trying to control Bitcoin, how they're going about it, whether they will succeed, and what it could all mean for the price of Bitcoin. This is a video you can't afford to miss. In November 2023, it was discovered that F2 Pool, one of the largest Bitcoin mining pools, had secretly been censoring Bitcoin transactions. In practical terms, this meant that they refused to process BTC transactions going to or coming from wallets that had been sanctioned by the US government. Thankfully, the solution to this censorship was simple. Miners simply started directing their hash rate to other Bitcoin mining pools that do not censor transactions. But it begs a question. What if most of these individual Bitcoin miners started censoring BTC transactions and not just the pools? We don't have to look very far to find the answer. Back in 2021, Marathon Digital, the largest publicly traded Bitcoin miner, announced that it had launched a mining pool that was compliant with sanctions imposed by the US's Office of Foreign Assets Control, or OFAC for short. It subsequently announced that 100% of its hash power was being directed to this pool. Now, if you're thinking, hey, no big deal, Marathon Digital is just 6% of Bitcoin's total hash rate, and there are lots of other miners. Think again. As of late last year, roughly 1/3 of Bitcoin's total hash rate came from public Bitcoin miners in the US, all of whom are subject to US regulations, including OFAC's. More importantly, their share of Bitcoin's total hash rate has been rising, and this trend is likely to continue. And that's just because public miners can do things like issue debt and sell shares to expand their operations and capacity. Most private Bitcoin miners can't do this as easily, if at all. And this means that more and more of Bitcoin's hash rate is likely to come from publicly traded Bitcoin miners in the coming years. And this is a bigger problem than you might think, because these Bitcoin miners aren't just being coerced by the government. They're also being influenced by asset managers. BlackRock, Fidelity, Vanguard, State Street, and other large asset managers happen to be the largest shareholders in most publicly traded Bitcoin mining companies. Now, for context, these asset managers are infamous for using their holdings of company shares to influence the operations of said companies. The most egregious example of this was the ESG investment ideology, which mandated that public companies use more expensive forms of energy, hire people based on characteristics other than merit, and put asset managers ahead of customers, basically the opposite of what companies should do. Fortunately, public opinion and politics have turned against these objectively harmful ideologies and practices. Unfortunately, public opinion and politics are something that can change very quickly. In a few years' time, ESG could come back with a vengeance, and this would be very bad news for Bitcoin. With the likes of BlackRock having significant influence over listed Bitcoin miners, this means that they could theoretically coerce them to support a switch from proof of work to proof of stake. And this switch would be successful if most of Bitcoin's hash rate came from these miners. And if you're thinking, well, that would never happen because they would need most of Bitcoin's developers and most BTC holders to agree to the change, think again. Asset managers like BlackRock are funding Bitcoin developers, and their spot ETFs are quickly accumulating a sizable chunk of BTC's circulating supply. Thankfully, powerful entities in the crypto industry are hyper-aware of this and are responding with countermeasures of their own. But if you weren't aware of this, then smash that like button to help raise awareness. And don't forget to subscribe and ping that notification bell as well. Back to the video. Now, about asset managers funding Bitcoin developers. If you watched our first video about Bitcoin and ESG way back in 2021, you'll know that we flagged the fact that ESG ratings agencies were working hard to figure out who the most influential Bitcoin developers were, presumably so that they could be influenced in some way or another. As a fun fact, ESG-obsessed asset managers like BlackRock never actually had a problem with Bitcoin's alleged environmental footprint, nor its alleged use in crime. And that's because they know that most Bitcoin mining is done using renewable energy, and only a fraction of Bitcoin transactions are criminal. What they did have a problem with, however, was Bitcoin's governance, aka control. As you'll know, Bitcoin technically has no formal governance process, and this means that Bitcoin can't be changed very much. It's a double-edged sword that's good for Bitcoin, but bad for BlackRock and company. That's because BlackRock and other asset managers want to have the ability to influence Bitcoin just like they do with publicly traded companies. Without shareholders or a formal governance structure, this is difficult to do, but it's not impossible. And you'll recall that Bitcoin miners are just part of the equation. Bitcoin developers and BTC holders are the other parts. And if you watched our video about Bitcoin's block size war, you'll know that less than a decade ago, Bitcoin developers and holders successfully prevented miners and institutional investors from increasing the block size, ensuring that Bitcoin remains decentralized. The fact that these institutional investors started getting interested in developers after the block size war suggests they learned from their mistakes. If you want to influence Bitcoin, it's not enough to influence the miners. You need to influence Bitcoin developers as well as the holders. And how do you influence these parties? With money, of course. Asset managers like Bitwise and VanEck are donating to Bitcoin developers and are using a portion of their spot Bitcoin ETF proceeds to do it. The good news is that larger asset managers like BlackRock and Fidelity aren't known to be doing the same. The bad news is that Bitwise and VanEck's decisions to fund Bitcoin development opens the door to larger asset managers doing the same. In other words, they've arguably set a dangerous precedent that could result in other asset managers donating millions of dollars to influence Bitcoin's development. And this is terrifying when you combine this influence with the terms and conditions of the spot Bitcoin ETFs these asset managers offer. In case you missed the news, BlackRock's ETF contains a clause that states BlackRock reserves the right to decide which Bitcoin fork the ETF supports, if there's a fork. And if you watched our recent video about the biggest risks to Bitcoin, you'll know that the threat of a quantum computing attack means a Bitcoin fork is essentially guaranteed at some point. And this means that in the not-too-distant future, BlackRock will have the power to influence which Bitcoin is the real Bitcoin. And some claim that most holders will reject this version that BlackRock supports if it goes against Bitcoin's ethos. But it's evident that most Bitcoin holders care more about profits than true financial freedom. They would likely embrace the version supported by asset managers and sell the other. And this would result in the unsupported fork of Bitcoin going the way of other forks, slowly fading in value and relevancy. All we can do is hope that the Bitcoin developers that implement this apparently inevitable fork aren't completely captured by the interests of asset managers by the time it happens. And you'll recall that asset managers would likely have a significant influence over Bitcoin's hash rate via their stakes in listed Bitcoin mining companies by that point. And it's also worth remembering that most of the freely tradable BTC could also end up being held by ETFs due to their legal protections. The good news is that Bitcoin's price would likely perform well because of all this coordination. And if you're trading Bitcoin already, then you should check out the Coin Bureau Deals page down below or with this QR code. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashbacks on deposits of up to 75% on the best crypto exchanges around. These deals won't be around for long, so take advantage of them ASAP by using the link down below or scanning this QR code. Now, this begs a bigger question, and that's whether asset managers like BlackRock could succeed in taking control of Bitcoin in the coming years. As with all great power politics, the answer ultimately depends on what the other side does. In this case, what companies in the crypto industry are going to do. For starters, it's important to note that not all asset managers are in favor of the kind of global governance that BlackRock explicitly engages in and advocates for. There are many asset managers that are aligned with the crypto industry, and Bitwise and VanEck happen to be two of them. And this means that their decision to use a portion of their ETF proceeds to fund Bitcoin development is likely being done to ensure that Bitcoin stays the way that it is right now. A decentralized digital asset that can be self-custodied and can't be controlled. And they're not the only ones. Tether CEO Paulo Arduino revealed in a recent Bitcoin documentary the stablecoin issuer will also begin funding Bitcoin development and could be doing so already. And notably, Arduino specified that Tether is doing this to ensure that Bitcoin stays the way that it is, so that BTC retains its value indefinitely. And this is worth noting because it's also something we flagged in our recent video about what happens when the last Bitcoin is mined. The TLDR is that we speculated that governments could begin mining Bitcoin to ensure that its blockchain remains neutral and transactions are processed normally. In case you didn't notice, this is effectively what Tether is doing, and not just in terms of funding Bitcoin development. At the recent Bitcoin conference in Las Vegas, Arduino revealed that Tether has quietly become the largest miner by hash rate, and said they've deliberately been keeping this fact low-key. In retrospect, it's not that surprising. Tether has been investing hundreds of millions of dollars into Bitcoin mining in recent years, including buying large stakes in listed miners. Tether has also been investing billions of dollars into energy production in countries like El Salvador. As a cherry on top, Tether has been using a portion of its monthly profits to buy BTC. It recently revealed that it holds 100,000 BTC, and chances are that this stack is going to keep growing. For reference, Tether makes most of its money from the yield it earns on USDT's reserves, namely US bonds. According to a Bloomberg report earlier this year, Tether made a staggering $13 billion in profit in 2024. Not revenue, profit, as in the money that's left over after all expenses were paid. To put things into perspective, BlackRock's profits of 2024 were $6.4 billion. And this means that Tether literally made twice the amount of profit as BlackRock, the world's largest asset manager. And this is money that Tether can use to do things like invest in Bitcoin mining operations, fund development, and accumulate BTC, all to ensure that Bitcoin remains true to its ethos. Speaking of which, it's not just Tether that's been accumulating BTC either. Companies like Strategy have been accumulating billions of dollars worth of it too, and it looks like these so-called Bitcoin treasury companies are on the same page about BTC being truly decentralized digital money. In sum then, while there are powerful TradFi entities like BlackRock looking to influence Bitcoin, there are equally powerful crypto entities like Tether that are actively doing the same. Whether this fundamentally undermines Bitcoin's decentralization is up for debate, but we reckon it's both ideal and inevitable. It's ideal because you have two powerful factions doing a tug of war, and Bitcoin will probably remain in place as a result, so to speak. It's also inevitable because as the importance of the Bitcoin blockchain rises and BTC's value increases, more and more entities will try to influence both. Although this tug of war is currently limited to private entities like Tether and BlackRock, it's likely that nation-states will start pulling on the proverbial rope, and some would say that this is starting already. Again, this could be paradoxically good for Bitcoin, as competing interests would cancel themselves out. There's just one more elephant in the room that we need to address though, and that's Bitmain. Now, for those unfamiliar, Bitmain is the largest manufacturer of Bitcoin mining machines, also known as ASICs. According to a Bloomberg report last year, Bitmain has a whopping 90% market share of these ASICs. Given this fact, it stands to reason that whoever influences Bitmain could likewise exert influence over Bitcoin. And this is where things get interesting. because Bitmain is a Chinese company, with its headquarters still continuing to be in Beijing, despite China's ban on Bitcoin mining and restrictions on crypto more broadly. However, Bitmain's largest investors all appear to be based in the US, namely Sequoia Capital, which is based in California. In turn, Sequoia's earliest investments seem to have focused on startups in China as well as Israel and India. As another fun fact, Sequoia was one of the first investors in Apple, which went on to play a key role in growing China's advanced manufacturing capacity, according to multiple reports. And this makes it hard to know who influences Bitcoin. Is it the Chinese government or is it Sequoia? And if it's Sequoia, could Chinese interests still be involved somehow? To add to the complexity, Tether, being the largest Bitcoin miner, likely means that it's also Bitmain's largest customer. Not only that, but BitDeer, one of the listed miners Tether invested in, was originally part of Bitmain. On that note, some of you might know that Bitmain tried to IPO in the past. Believe it or not, but this could have been bad for Bitcoin because it could have made one of the most important companies in Bitcoin vulnerable to capture by inherently anti-crypto asset managers like BlackRock and Vanguard. And that's why we're concerned about the possibility that Bitmain could try to IPO again in the future. With a crypto-friendly SEC in the US, it would be incredibly easy for them to do it. For what it's worth, though, companies don't IPO unless they need to raise capital or because early investors want to exit. And it doesn't look like Bitmain needs more money, and its monopoly probably means its investors don't have any interest in exiting. If we do see Bitmain file for an IPO, though, it could be a huge red flag for Bitcoin's future and its price. And this, of course, brings me to the big question, and that's what all of this means for Bitcoin, the network, and BTC, the asset, which I'll remind you are technically two separate things. And if you've been paying attention, you'll already know the answer. Bitcoin will remain mostly unchanged, and BTC will likely benefit. And that's because you'll have at least two powerful factions looking to influence Bitcoin by expanding its mining capacity, improving its development, and buying more and more of it. In case it wasn't obvious enough, these dynamics will be beneficial both for Bitcoin, the network, and BTC, the asset. And I'll reiterate that we'll see more powerful factions getting involved as Bitcoin and BTC continue to grow. And this will only accelerate this dynamic, making Bitcoin better and pushing BTC's price higher and higher. However, this assumes that there's never a decisive win in this growing tug of war. If Tether or BlackRock were ever to experience issues that affected their ability to influence Bitcoin, then the other side could win. For instance, if one of the custodians holding the BTC back in BlackRock's ETF shares was to be hacked, this would result in a mass exodus out of these ETFs. And this would practically result in the pro-crypto camp winning the tug of war, as it would result in more BTC holders keeping their sats in self-custody. On the flip side, though, a loss of confidence in ETFs and the like could limit the ability of large pools of capital to allocate to BTC, creating a headwind for its price. Conversely, if interest rates were to go back to zero, then Tether's eye-popping profits could fall to zero as well. It goes without saying that zero interest rates would be rocket fuel for Bitcoin's price, but it could simultaneously restrict Tether's ability to exert influence over Bitcoin, giving BlackRock the higher ground. Considering this dynamic, it's incorrect to say that Bitcoin is successful because nobody controls it. On the contrary, Bitcoin is successful because powerful entities are constantly trying to control it. And the tug of war this creates results in an equilibrium where Bitcoin becomes more robust and BTC grows. So long as neither side scores a decisive victory, Bitcoin will continue to be successful. But never forget that powerful individuals and institutions hate losing. If one side gets a sense that the other side is winning, then they could resort to drastic measures that damage the Bitcoin network and tank BTC's price. A quantum computing attack would be one way to do it, and you can learn all about how quantum computers could crack Bitcoin by watching this video right over here. And if you're not subscribed to the channel yet, you can do that right over here. This is Nick signing off. Thank you very much for watching, and I'll see you guys again soon.